Good morning. Welcome, everyone. This is an open meeting of the Public Company Accounting Oversight Board on December 15th, 2015. We want to welcome all of you who have joined us today in person or listening to the webcast of this meeting. Today, the Board will take up a recommendation to adopt new rules and related amendments to its auditing standards to require disclosure of certain audit participants on a new PCAOB form. Before we proceed with the agenda, I will note for the record that all board members are present. The first and only order of business before the board today is a staff recommendation that the board adopt new rules and related amendments to its existing auditing standards that will improve transparency regarding the engagement partner and other accounting firms that participated in the audit. To present the staff's recommendation on this agenda item, I will turn to our Chief Auditor, Martin Baumann. Mr. Baumann.
Thank you. Good morning, Mr. Chairman and board members Harris, Ferguson, Hanson, and Franzel. The Office of the Chief Auditor is pleased to recommend that the board adopt new rules and related amendments to its auditing standards that will provide investors and other users of audited financial statements with new information about who performed the audit, the name of the engagement partner, and the names and extent of participation of other accounting firms that took part in the audit. I will turn to Jennifer M shortly to present our recommendation, but before I do, I'd like to acknowledge the many people within the PCAOB who provided significant contributions to this project. First, I'd like to express my sincere appreciation to Jennifer, Jessica Watts, Lisa Calandrello, and Karen Wiedemann of the Office of the Chief Auditor, the team that led this project. They worked tirelessly to get this recommendation to the board before the end of this year. And faced with many difficult challenges to this rulemaking over the years, their dedication and commitment to this project demonstrates the best of the PCAOB's commitment to protect the interests of investors. I would also like to thank our colleagues from the other divisions for their significant contributions, in particular, Andres Vanelli and Morris Mittler in the Center for Economic Analysis, Nirav Kapadia and Steve Rea in the Office of Information Technology, Sarah Williams and Carl Hierman in the Division of Registration and Inspections, and Gordon Seymour and Vince Meehan in the Office of General Counsel. Finally, I'd like to thank the staff of the Securities and Exchange Commission for their support and timely assistance to this project. Jennifer?
Thank you, Marty. Good morning, Mr. Chairman and members of the board. We are here this morning to recommend that the board adopt new rules and related amendments to auditing standards to provide transparency to investors regarding the engagement partner and other accounting firms that took part in the audit. This project is supported by many years of outreach. The board began this project in 2009 in response to a recommendation of the U.S. Department of the Treasury's Advisory Committee on the Auditing Profession by issuing a concept release. Through 4 rounds of comment and numerous discussions with the board's standing and investor advisory groups, the project evolved from the initial concept release, a partner signature on the auditor's report, to now a form filed with the PCAOB that not only includes the name of the partner's name, but also information about other participants. During this time, the board has received consistent comments from investors that stress the importance and value to them of increased transparency and accountability in relation to certain participants in the audit. These commenters indicated that access to such information would be relevant to their decision-making, for example, in the context of voting to ratify the company's choice of auditor. Historically, in the United States, investors have not known the name of the engagement partner or other accounting firms until a problem such as a restatement occurs. However, the engagement partner, who is a member of the engagement team with primary responsibility for the audit, plays a unique and critical role in the audit. Additionally, in many audit engagements, especially audits of public companies operating in multiple locations internationally, the firm signing the auditor's report performs only a portion of the audit. The remaining work is performed by other, often affiliated accounting firms that are generally located in other jurisdictions. Disclosure regarding the engagement partner and other accounting firms that took part in the audit will provide transparency to investors and should also promote increased accountability in the audit process. I will now turn the floor over to Jessica Watts and Lisa Calandrello, who will provide more information about the new rules and amendments. the principal ways in which the requirements under the final rules differ from what was described in the Board's 2015 supplemental request for comment, and our plans to issue guidance to assist firms with implementation of these rules. Jessica?
Thanks, Jennifer. Form AP will provide information about the engagement partner and other accounting firms that participated in issuer audits. The requirement to file Form AP will be triggered the first time the auditor's report is included in a document filed with the SEC, such as an annual report filed on Form 10-K. Form AP will require disclosure of the name of the engagement partner for the most recent audit. Additionally, in order to distinguish engagement partners with the same name or those that may have changed his or her name, Form AP requires a 10-digit identifying number assigned by the accounting firm. If an engagement partner changes firms, a new partner ID is assigned, but the old number is also reported on any new Form AP associated with that partner. The required disclosures on Form AP for other accounting firms will differ based on the percentage of participation in the audit. For firms whose participation was at least 5% of total audit hours, the name, location, and percentage of participation of each of those firms is required. On the other hand, for firms whose participation is less than 5%, only the number of firms and the aggregate percentage of participation of all those firms is required. Auditors are allowed to estimate the total audit hours and the percentage of participation of other accounting firms. Form AP requires a firm ID for all currently registered firms as well as other accounting firms that have a publicly available PCAOB assigned number. This will alleviate possible confusion among accounting firms with similar names. Including a firm ID will also ensure that firms that have a publicly available PCAOB assigned number can more easily be linked to the other PCAOB registration and inspection data. The information filed in Form AP will be publicly available in a searchable database on the PCAOB's website and will add more specific data points to the mix of information that can be used by investors when evaluating audit quality. By putting this information in a database, it will be easier to link bad actors with bad acts. At the same time, partners will be able to develop reputations for high audit quality based on their industry specialization, audit history, and track records. Form AP will be required to be filed for all issuer audits, including audits of emerging growth companies. The new rules are not applicable to audits of brokers or dealers under Exchange Act Rule 17A5. In addition to the rules requiring disclosure on Form AP, there are also amendments to the Board's auditing standards that will allow auditors to voluntarily disclose in the auditor's report the name of the engagement partner, information regarding other accounting firms, or both. Allowing voluntary disclosure in the auditor's report responds to some investors' preference regarding location and timing for disclosures. I will now turn to Lisa for information on changes to Form AP since the SRC was issued in June, and our plans to issue guidance to assist firms with implementation of the new rules. Lisa?
Thanks, Jessica. The final rules have changed in several areas from what was described in the supplemental request for comment. First, I'll describe changes made regarding overall implementation of the new rules. Next, I'll describe other changes that affect the required disclosures. The changes that affect overall implementation of the rules include the filing deadline. The filing deadline has been slightly extended beyond the 30 days contemplated in the supplemental request for comment. To 35 days after the date the auditor's report is first included in a document filed with the SEC. This 35-day deadline would allow information to be provided to investors prior to the annual shareholders meeting in most cases, thus making the information available in time to inform voting decisions and also provide firms with sufficient time to file Form AP. The 10-day deadline in IPO situations was retained from the SRC. This would allow information to be available in advance of an IPO roadshow, if applicable. Next, the effective date. The effective date is later than what was contemplated in the supplemental request for comment. After considering a balance between providing investors with the engagement partner's name as soon as reasonably practicable and providing firms with time to develop a methodology to gather information regarding the other accounting firms' participation, the final rules provide a phased effective date. If approved by the Commission, the new rules of the Board and amendments to auditing standards will take effect. For the engagement partner, the rules will apply to auditors' reports issued on or after January 31st, 2017, or 3 months after SEC approval of the final rules, whichever is later. For the other accounting firms, the rules will apply to auditors' reports issued on or after June 30th, 2017. Essentially, the effective date would require disclosure of the engagement partner names for 2016 calendar year-end audits and unique identifiers. Finally, as Jessica mentioned, Form AP requires the disclosure of a unique partner ID and firm ID. Next are other changes made to the required disclosures. This includes excluding non-accounting firms from the disclosure. While non-accounting firms may participate in the audit, the intent of disclosure is to provide information about the participation of other accounting firms, and information about non-accounting firms may not be as meaningful to users. While non-accounting firms are not required to be separately disclosed, the hours incurred by these participants will be included in the calculation of total audit hours, and the rules describe how this will work. This also includes specifically allowing for the use of reasonable estimates in the computation of total audit hours and the percentage of participation when actual hours are unavailable, and excluding accounting firms performing only an audit of an equity method investee. Finally, although no change was made, I'd like to describe our response to commenters' request for batch filing. Though several firms preferred the ability to file information for multiple audit engagements on a single Form AP, the final rules require one Form AP per auditor's report. The system, however, will allow submission of multiple forms simultaneously using an extensible markup language similar to other PCAOB forms. Before I turn it back to Jennifer, I'd like to describe our plans to issue staff guidance to assist firms with the implementation of Form AP. Topics that may be included in such guidance include application of the filing requirements, examples of computing total audit hours, including estimating audit hours when participants also perform a statutory audit, and illustrative language that may be included if an auditor chooses to voluntarily disclose in the auditor's report information about the engagement partner or other accounting firms that participated in the audit. The staff plans to issue the guidance after approval of the rules by the SEC, consistent with the timing of guidance issued in connection with other board rulemaking projects. Jennifer?
Thank you. As you've just heard from Jessica and Lisa, throughout this process, the staff has sought to balance the potential benefits of disclosure regarding engagement partner and other accounting firms that participate in the audit with concerns expressed by some commenters about its potential consequences. Toward that end, we have looked for ways to achieve the goals of increased transparency and accountability for auditors while limiting, to the extent consistent with those goals, potential unintended consequences. As a result, the staff is recommending that the board adopt two new rules, Rules 3210 and 3211, and one new form, Form AP. Additionally, the staff is recommending that the board adopt amendments to AS 3101, currently AU 508, and AS 1205, currently AU 543, related to voluntary disclosures in the auditor's report. The staff recommends that the board authorize the staff to submit these new rules and amendments to the auditing standards to the Securities and Exchange Commission for approval pursuant to Section 107 of the Sarbanes-Oxley Act, and to also request that the SEC approve the application of the new rules and amendments to auditing standards to the audits of emerging growth companies pursuant to Section 103 of that Act. That concludes our presentation, and we would be happy to answer any questions you might have. Thank you.
Thank you, Jennifer. The board meets today to consider adoption of new rules on audit transparency to require auditors to disclose the name of the engagement partner and information about certain other participants in the audit. The new rules will, in our own way, bring U.S. audits into line with international standards and practices that have proven effective for issuers, auditors, and investors alike in other markets. The American accounting profession dates back to the 19th century when a handful of respected accounting experts recognized the importance of a learned profession of public accountants who cultivated, through integrity, expert training, and knowledge, a reputation for reliable, independent assessments of accounts. The modern audit profession has come a long way since these beginnings, but our system of federal securities regulation remains integrally linked to the work of these early accountants and their impeccable reputation for wisdom and integrity. It was on the basis of the public's trust in these professionals that starting in the 1930s, the Congress required all publicly traded companies to file with the then new commission financial statements that had been audited by an independent public accountant. To meet the mandate, accounting firms have multiplied through hiring and acquisitions to include hundreds of thousands of professionals. The largest accounting firms now include hundreds of audit partners. Irrespective of this institutionalization, auditing is still a business about reputation. The firm name is clearly part of that reputation, but the names of the individuals entrusted with the franchise have been lost in the sea of expansion. In this regard, the profession is an outlier among participants in the financial reporting chain. The names of corporate board members, CEOs, CFOs, other senior management are already disclosed. It allows the market to provide nuanced signals to dispersed investors about how to price the cost of capital. Based on nearly 13 years of experience, PCAOB inspections have revealed that even within a single firm, and notwithstanding firm-wide or network-wide quality control systems, the quality of individual audit engagements vary. There are numerous factors required to achieve a high-quality audit, but the role of the engagement partner in promoting quality or allowing it to be compromised is of singular importance to the ultimate reliability of the audit. So, too, inspections have found that auditors face and make important choices about how to organize multinational audits. There's no way for an investor to tell today how much of an audit was performed by firms other than the signing firm. In the case, say, of a large financial institution with major operations in 2 or more financial centers, a significant portion or even most of the audit may be performed by firms other than the signing firm. Transparency about the partner and the firms involved should further incentivize the audit firm to organize the audit team conscientiously and to give investors comfort that that team is reliable. The project began in earnest in response to a 2008 recommendation of the Treasury Department's Advisory Committee on the Accounting Profession that engagement partners be required to sign their audit reports. Since then, we've engaged in extensive research and deliberation and multiple rounds of public comment to arrive at the proposal before the board today. I believe the rules before the board today reflect a thoughtful and flexible approach that reinforces the PCAOB's mission to protect investors from poor auditing and to promote their interest in more informative, accurate, and independent audit reports. The fact that the new disclosures will be consolidated in a database available on the PCAOB website means that investors, analysts, audit committees, and others can conduct meaningful comparisons. At the same time, this approach addresses firms' concerns regarding liability consequences to their partners and to other firms. I'm grateful for the public comments we've received on our proposals. They've been enormously helpful to confirm the benefit of the disclosures, minimize costs, and identify and address unintended consequences. The action we take today could not have been achieved without the encouragement and support of the Honorable Mary Jo White, Chair of the SEC, and the active involvement of her Chief Accountant, Jim Schnurr. To both, I want to express my thanks. I also thank the other SEC staff who worked on this project, as well as my fellow board members, for their close consultation in this effort. Their assistance has been critical to helping us bring this project to fruition. Finally, let me express my deep gratitude to the staff in the PCAOB's Office of the Chief Auditor, the Office of the General Counsel, and the Center for Economic Analysis. Their indefatigable openness to research and evaluate various approaches to achieve our goals, and their tireless attention to detail have made today's action possible. I will now turn to my fellow board members for any statements they may wish to make. We will withhold questions until all board members have had a chance to make a statement, and then we'll have time for our usual questions and discussion. With that, Board Member Harris.
Thank you, Mr. Chairman, and congratulations to you and all involved who have worked tirelessly on bringing this initiative to a final vote this morning. Without your patience, persistence, and leadership, I do not believe that this transparency project could have ever succeeded. As you mentioned, this issue has been before the board in one form or another since at least 2009, when President George W. Bush's Treasury Advisory Committee on the Audit Profession recommended that the engagement partner be required to actually sign the auditor's report. This is now the board's 5th open meeting on this subject, and my views concerning this topic are reflected in my previous open meeting statements. The board has heard from a number of constituencies, each of which has strongly held perspectives. Investors and regulators alike do not believe that audit quality is where it should be. Investor representatives believe that requiring a signature on an audit report would increase an engagement partner's sense of accountability and responsibility, and hence prompt positive changes in his or her behavior, all in the service of improved audit quality. I should add that the same reasoning compelled the drafters of the Sarbanes-Oxley Act to include a provision mandating a personally signed certification from the Chief Executive Officer and Chief Financial Officer with the quarterly and annual reports filed with the Securities and Exchange Commission, wherein the executives certify, as the auditor does in the audit opinion, that the financial statements conform to generally accepted accounting principles and fairly present the financial condition and results of operations of the company. On the other hand, the audit profession believes that while an engagement partner is a member of the audit engagement team with final responsibility for the audit is the result of a group effort. My position is well known. I see no reason why auditors should be treated any differently from other professionals, such as architects and engineers who must sign off on their work product, or as mentioned, CEOs and CFOs who are similarly required to attest to their company's financial statements. I also agree with investors that engagement partners should be held individually accountable for the audit work and ultimate result of the audit engagements they are responsible for supervising. Since 2009, this board has heard a number of arguments against our signature proposal and the related disclosure proposal, which would have provided auditors with the option of placing their names in the auditor's report instead of signing it. The most persistent of these arguments is the assertion that engagement partners would have to contend with heightened liability concerns if their names appear in the auditor's report. It is worth noting that all the liability arguments that we have heard have been premised on the idea that the engagement partner should not be liable for deficient audits that harm investors, even if those audits are carried out so recklessly as to meet the legal standard for fraud. But it's not clear to me, at least, why this should be the board's goal. As Brandon Reese, Deputy Director of the Office of Investment for the AFL-CIO, stated in his comment letter, quote, "Many audit firms have objected that requiring engagement partners to personally sign or disclose their names in audit reports may result in enhanced legal liability under Section 11 of the Securities Act of 1933. He goes on to state, quote, "However, from the standard of investors, imposing Section 11 liability on auditors for material omissions or misstatements is beneficial. Auditors may limit their Section 11 liability by conducting audits with appropriate due diligence, and this will create an incentive for improved audit quality," close quote. As Ann Simpson, Investor Director of CalPERS, succinctly put it in her comment letter, quote, "When there is a high-quality audit, there is no fear of liability. When there is a high-quality audit, there is no fear of liability, and if the audit falls short, investors should have adequate recourse." These arguments seem to assume that engagement partners today face no liability, but the SEC and PCAOB can and do pursue disciplinary actions against engagement partners who fail to carry out their responsibilities. And while Janus and other Supreme Court decisions may have limited engagement partners' potential liability in private federal court actions, as James Cox, professor of law at Duke University, explained in his detailed comment letter, state law actions against an engagement partner, although rare, can be maintained. Finally, there are other more practical reasons to think that engagement partner transparency will not significantly affect those partners' litigation risk. As others have noted, the primary reason why engagement partners members are not included as defendants in private civil litigation is due to the general perception that they do not have sufficient assets to satisfy any judgment, not because their identity is unknown or because legal theories of potential individual liability are absent. The bottom line is that engagement partner disclosure will neither significantly change the liability landscape nor create adverse, unwarranted consequences. The last time this issue came before the board, I mentioned that requiring the engagement partner's name to be disclosed in a new form, as opposed to the auditor's report, quote, would isolate the United States from an emerging global consensus on the manner in which the name of the engagement partner should be disclosed, close quote. This is not just a matter of opinion, but a well-documented fact. 16 out of 20 countries with the largest market capitalization, including 7 European Union member states, already require disclosure of the name of the engagement partner in the auditor's report. I continue to believe that investors in the United States are entitled to the same. For me, this issue has always been more about improving audit quality, which is not where it should be, by enhancing and influencing a leader's sense of individual accountability and acceptance of responsibility for a team effort he or she has led by signing his or her name to a most commonly reviewed report, as opposed to simply being identified in a newly developed form. However, I understand that reasonable people may agree to disagree, which is why I support today's compromise, which will result in the creation of a new standardized form, the Form AP, the AP standing for audit participants. As a result of this proposal, audit firms will now be required to identify the audit engagement partner for a particular audit on this form, rather than the audit report, which is a primary vehicle by which the auditor communicates with investors about the audit. The information in Form AP will be available on our website, which will provide investors, audit committee members, and other interested parties with an opportunity to evaluate and compare the performance of individual engagement partners as well as other participants in the audit. Some of the benefits, as Jessica Watts outlined, of identifying the engagement partner on a standardized form include, over time, providing investors with a means to determine whether certain engagement partners have been associated with adverse audit outcomes that could be attributed to deficiencies in their audit work or have been sanctioned by the SEC or PCAOB. Enabling investors to understand how much of the audit was performed by the firm issuing the report and how much was performed by other firms, including those practicing in jurisdictions where the PCAOB has been unable to conduct inspections. Revealing to investors for the first time situations in which the engagement partner has been placed before rotation was required, and reinforcing the engagement partner's sense of professional responsibility and accountability for the quality of the audit through awareness that his or her name can be publicly associated with the audit that he or she supervised. In addition, as the disclosed information is aggregated and analyzed in conjunction with other publicly available information, investors will gain valuable data about the conduct of engagement partners, and investors will be able to make more informed decisions when asked to ratify the company's independent auditor. I also support requiring audit firms to disclose the names and locations of any other firm that provides at least 5% of the total audit hours for any given audit report. Currently, audit quality differs materially among various countries, and this additional disclosure will, as Jeffrey Johans of the University of Texas says, allow, quote, users of financial statements to understand which public accounting firms are actually performing the audit work and where they are located, because many recent accounting fraud cases in the U.S. have involved poorly supervised foreign firms performing low-quality audits. Mr. Chairman, after 6 long years of contentious debate on this subject, I'm glad we are now able to get this issue behind us and move forward to finalize other long-standing proposals, such as modernizing the outdated audit reporting model and improving auditor going concern reporting under Section 10A of the Securities Exchange Act of 1934. A brief word about each. The auditor's reporting model remains a high priority of mine because it's a primary means by which investors and other stakeholders acquire information about the audit. In its current incarnation, the auditor's report conveys minimal information about the data obtained and evaluated by the auditor as part of the audit. The report has changed very little since the 1940s, and investors contend that it must be updated to provide additional information that will make it more relevant and useful to investors and other stakeholders. I strongly agree. As with the identification of the engagement partner, I would note that the United States lags behind much of the rest of the world in this area as well. With respect to going concern, investors did not understand how so many large companies that were significantly affected by the events in the recent financial crisis received clean opinions from their auditors. Nor do they understand how it is possible that out of the 25 largest issuer bankruptcies that occurred between fiscal years 2003 and 2012, representing a combined market capitalization of approximately $70 billion, only 3 received the going concern opinion in their most recent audit report before filing bankruptcy protection, which raises the question, where were the auditors? In August 2014, the Financial Accounting Standards Board updated U.S. Generally Accepted Accounting Principles to establish new requirements for a management going concern assessment and related financial statement disclosures. If the PCAOB were to follow FASB's threshold for financial doubt in the auditing standards, it would result in auditors issuing even fewer going concern opinions. In other words, more clean opinions, notwithstanding the recent financial crisis. The PCAOB, however, must adhere to a different obligation from the FASB. Section 10A of the Securities Exchange Act requires auditors to include an evaluation of whether there is substantial doubt about the ability of the issuer to continue as a going concern during the ensuing fiscal year. This provision was enacted into law in 1995 in response to the savings and loan crisis, which cost the American taxpayer some $132 billion, and was intended to give investors an early warning before a company's financial difficulties became severe. This subject has been repeatedly discussed by the Board's Investor Advisory Group in 2011, 2012, 2014, and 2015, and has been taken up internationally. But taking one step at a time, at this point, I am pleased that we have at long last concluded this transparency project, and investors will soon know the name of the engagement partner as well as the other participating firms on a particular audit. So I thank you, Mr. Chairman, and I ask that my full statement be made a part of the record.
Thank you, Steve. As usual, we have the problem in this board of knowing what board members really think. Board Member Ferguson.
Thank you, Mr. Chairman. I support the current proposed standard to require disclosure of the name of the audit engagement partner and the names of the other auditors participating in public company audits. Under this proposal, disclosure of this information would be required to be filed with the PCAOB in a new PCAOB Form AP, standing for audit participants, as my fellow board member Harris mentioned. The information could also, at the auditor's option, be disclosed in the auditor's report, but that's not required. I've made a number of statements in support of this effort over the years. On June 30th, 2015, I outlined my thinking as to why the engagement partner's name should be disclosed. On December 4th, 2013, I outlined in even greater detail my reasons for supporting the proposal, as well as my reasons for supporting the disclosure of the other auditors participating in the audit. Instead of repeating myself, I want to refer to those statements and point out that part of the reason the proposal has been so long in coming is that we as a board have struggled with reconciling the disclosure of the information with the minimum achievable adverse consequences with respect to auditors' liability. As a result, this final proposal looks a bit different from where we started in 2011. And I believe that's because we have found an appropriate compromise that allows the board to achieve the primary goal of getting potentially valuable information into the hands of investors while minimizing the risk that auditors incur significantly increased liabilities or administrative burdens. It may be that it's impossible completely to eliminate all risk of increased liability, but this proposal, by only requiring disclosure of the information in a separate form rather than in the auditor's report itself, should eliminate the necessity for auditors and other participants to file consents under Section 11 of the Securities Act of 1933 for the inclusion of their names in certain filings under the 1933 Act, thereby minimizing the risk of Section 11 liability for the disclosure. It also eliminates what could be a serious administrative burden, particularly where participants in the audit are not in the United States. In addition, since the information is not required to be included in the auditor's report, I also believe the proposal significantly reduces the risk to auditors under Section 10B and Rule 10b-5 of the Securities and Exchange Act for statements made in the report itself. Our staff has worked tirelessly for many years now on this proposal, and I commend their dedication to this project. In particular, I want to join my fellow board members in thanking the Office of the Chief Auditor, including Marty Baumann, Jennifer Rand, Jessica Watts, Karen Wiedemann, and Lisa Calandriello. Thanks also to the Center of Economic Analysis, to Andre Spinelli and Morris Mittler, our Office of General Counsel, Gordon Seymour, and Vince Meehan. The Office of Information Technology also did yeoman's work on preparing the form and making it fit into our information technology systems. So I want to thank Nirav Kapadia and Steve Rea for this. Now, a number of divisions of the SEC, including commissioners themselves and their offices, and particularly members of the Office of Chief Accountant, Brian Croto and Jeff Minton specifically, have also worked both hard and creatively on this proposal over the years, and for that we are very grateful.
Thank you, Lewis. Board Member Hanson.
Good morning. I'd like to echo the thanks that my fellow board members have given the staff without naming them all again, but I really appreciate all the work from everybody in the Office of the Chief Auditor, the General Counsel's Office, the Center for Economic Analysis, the Division of Registration Inspections, and our IT folks. So I support the adoption of the proposed rules and amendments that will provide investors and other financial statement users with information about engagement partners and accounting firms that participated in the audits of issuers. In prior statements, I expressed concern about whether our earlier proposals provide an appropriate balance of the potential costs and benefits with the contemplated requirements. Having thoroughly explored these issues over the past several years, I believe the rules and standards we are finalizing today, requiring the respective disclosures in a PCAOB form to be filed and made public on our website, represent the most practical approach and will provide investors with information they have long requested without imposing unreasonable burdens on auditors or issuers. The new requirements provide information about the identity and extent of the participation of other audit firms in an audit may be very useful to investors. This information has historically been unavailable to investors, in part because our standards prohibited disclosure of this information in most cases. Identifying the other firms that participated in the audit will permit investors to consider all the relevant information that may be available about the other firms, including their size, network affiliation, and location, especially if they're in foreign jurisdictions, in their areas of expertise, and whether the firms are registered with the PCAOB and their inspection results, if any. Firm identity and reputation is often the only basis, however imperfect, on which investors can judge audit quality, and the standards we are adopting today will increase transparency into the identity of the firms participating in the audit. In light of the investor demand for the information, I also support the new requirement for the disclosure of the identity of the engagement partner. Having worked in the audit profession for many years, I am very aware of the importance of this role to a high-quality audit, and I understand investors' desires to have access to this information. It will, of course, take time for investors or commercial data aggregators to accumulate partner-specific information to provide the context for the disclosures we are requiring today. But over time, coupled with the information about the partner's experience and history, making this additional information available to investors may incrementally increase their ability to make judgments about audit quality and, by extension, the credibility of the financial statements. Pending the SEC approval, the rules we're adopting today will be effective for audit reports issued in 27, first for the engagement partner disclosure, and then, as was discussed, the other firms. Between now and then, as the staff has mentioned, they're working on this implementation guidance to help firms better understand the requirements. And any firm that looks at the final rule in the next few months and has questions, I encourage them to submit them to the staff so we can make this implementation guide as complete as possible. Finally, I'd also like to thank the staff of the SEC for their input, as well as all the individuals and organizations that provided comments on our series of proposals over the past several years. This last round of feedback provided very useful operational suggestions and questions, which led to one important addition, this unique partner identifier that staff talked about. Our approach improved as a result of all the input we received over the years, and we appreciate commenters' time and attention.
Thank you, Jay. Board Member Franzel.
Thank you. I will also echo my thanks to the staff. I think what's very impressive about this project is the interdisciplinary nature of the team. We had economists working with auditors, working with lawyers, working with IT folks, and that's sometimes a tough slog, and so I congratulate all of you. I support today's vote on the adoption of these rules and amendments to require the disclosure of the name of the engagement partner and information about other firms participating in the audit. I'm pleased we've found a way to provide this information to investors and other users in response to the various recommendations over the years dealing with this issue. As the adopting release today acknowledges, and as other board members have and the staff, this project has gone through multiple iterations over the years, but really trying to seek a way to achieve the benefits that we're trying to achieve without having too many potential unintended consequences. And I think we found that balance. And again, I congratulate the staff. One of the advantages of going last is I don't have to reiterate what's in the standard or the history of this project, and so I will not do that. I do think, though, I want to mention one thing that hasn't been mentioned, the importance of disclosure. Disclosure can have a disinfecting effect, and previous board proposals have sought input on way to achieve this, and also the sense of accountability. And again, I think that the rules today achieve those objectives. It is also important to note that, really the baseline conditions have changed pretty significantly since 2005 when the staff started looking into this project, and the board currently has a number of significant projects aimed at improving audit quality. And so I think this, combined with the work of the staff and the board on many of these other projects, are all helping to achieve that goal of increasing accountability and transparency and increasing audit quality as well. So I think that the disclosures about accounting firms participating in the audit should be immediately useful to investors and other users when the rule becomes effective, and as the release acknowledges the partner name, it'll take some time for that to become useful. But in closing, again, I want to join my fellow board members in thanking the staff, and congratulations.
Thank you, Jeanette. One of the benefits of going last in the statements is you get to open on the questions. Would you like to ask a question?
All right, thank you. So we've got the effective dates in this release, and then these are based on the audit filing dates, and then there's time after that even for this information to be filed. So when will investors and other users see those first Form APs getting filed? When will they actually have the information starting to come in on engagement partners, and then secondly, other accounting firms?
Okay, so as mentioned in some of the comments, there were a lot of comments from participants, commenters, that said that the proposed effective date of June 30th was not 2016, did not give sufficient time for the building of systems within firms to aggregate this type of information to provide it to the board reliably. We listened to those comments thoughtfully and examined alternative approaches. As such, we've determined to have a phased effective date for this, and so for the engagement partner, Form APs will be required for reports issued after January 31st, 2017. And as Lisa Calandrello mentioned, that would effectively mean for year-end 2016 audits, engagement partners would be identified for those audits.
So that would be coming in then in April, correct? April of 2017.
Right. After
March, April.
Yes, for reports issued after January 31, 2017. Could be reports issued as soon as February 2017, but effectively for year-end 2016 audits. So that information would be available for investors and other users to determine who was the engagement partner on a particular audit, and if they wanted to know, well, what other work did that engagement partner do because of whatever reason, it would be searchable on the database to find out what other audit reports for that particular year, 2016, that engagement partner was associated with. The work with the information with respect to other firms, based on the comment letters, was more complicated to gather and build the data and information systems to structure. And so given that need and our careful analysis of comments, we've determined that that information wouldn't have to be provided until June reports issued after June 30, 2017. So that information would start to be available after that date for analysis.
And just a quick follow-up, then we've mentioned databases and searchable functions. How is this going to work? How can people access this data and maybe even download it and work with it?
Well, Lisa, why don't you answer that question?
As we discussed in the June supplemental request for comment, we're developing a searchable database on the public website of the board to make as few access points, as commenters have noted, as possible to get to the information. And that search functionality would include the ability to download results within the search engine directly so that any user could get whatever information they want, either in whole of what's in the database or a subset depending on what their purpose is and use.
Thank you.
Okay.
So, Lisa, I was glad to hear your description of the implementation guide, and I think it's really good, and you've been getting lots of good feedback from me, especially on the questions to include. And I know some of the questions came in, and Marty, you mentioned this challenge of the accumulating hours to be able to do this calculation for the firms, and that's one of the reasons that we had a staggered effective date. And Lisa, you mentioned that the final rule includes the ability to use estimates for the other firms, but if you could just play a little bit more for me on that. And I know one of the questions in common practice in many parts of the world are statutory audits, and so maybe an auditor in another part of the world is doing a statutory audit as well as helping the lead auditor, and I understand there's sometimes a challenge to separate those hours out. So if you maybe play a little bit more about what you were thinking about how that would be implemented, and really for the broader question of estimation, if there's going to be any hard and fast rules about how a firm must estimate, or if there's some latitude there.
Why don't I start, and then Lisa can fill in some of the details that I'll probably omit. The key thing, though, to start with is the form has to be filed 35 days after the date of the audit. So after the audit is included in a filing with the SEC. That created some challenges, the firms have told us, in terms of collecting the information. Now, of course, firms should not wait until the last minute to start to collect that information from their other firms around the world. As part of the planning process, they could certainly know all the firms that are participating, have a general idea of their scope of work, and have a process in place to start to begin to have the other firms collect their hours, make sure they're accurate, and deliver it to the lead auditor so that they get that within 35 days. Now, since it's at around shortly after the end of the audit being done, some of that work at the end of the day may have to be estimated. It couldn't be exact in all cases. And so we've said, yes, you can use an estimate, a good faith estimate of what the hours are of the other firms that participated in the audit for purposes of determining the hours of the individual firms, whether they exceeded the 5% threshold, and then the range within disclosures that have to be made. You don't have to disclose exact numbers. Again, we listened to commenters that said a range would be helpful of, say, from 5 to 10% of hours, or 10% to 20%, et cetera. So that's one of the reasons. In addition to that, with respect to the use of estimates, in many audits, other firms participate and not only do work on behalf of the lead auditor for purposes of supporting the auditor's opinion on the consolidated financial statements, they do work locally for a statutory audit to meet local requirements. That audit could be of greater scope because of a lesser materiality because it's expressing an opinion on that entity by itself. As such, it may be difficult to separate what hours were done for the statutory audit versus the hours or the piece of that supported the work on the consolidated audit. So we said that you could either estimate those hours that supported the consolidated audit, or you could use the statutory hours if that was a reasonable approach as well. We mentioned guidance that we expect to issue. These are the types of issues and calculations that we expect to put into the guidance. And as you mentioned, which is a very good comment, I appreciate it, after firms see the actual rulemaking, if they have questions that they want answered, it would be great for them to submit that further. And the guidance that we intend to issue shortly after the SEC's approval of this rulemaking would benefit from further questions that we get. Anything else? Thank you.
Lewis?
I don't know who this question should be directed to, but I think one of our underlying assumptions in approving this prospect project is that the information will be useful to investors, to other users of financial statements. And do we have any, and I assume if it is useful, that therefore we ought to, if it is in fact useful, we ought to actually see some impact from it at some point. Do we have any plans to do any kind of study of the impact of this proposal, and what in the future, and what kinds of studies would we do? What would we look at to try to determine that?
I'll start, and then maybe I'll pass it over to Andres Vanelli from our Center for Economic Analysis. But while we don't have specific plans at this date, Lou, we do have processes in place, first of all from inspections who looks at compliance with auditing standards after we issue them. So after we issue an auditing standard or a rule, inspections as part of their work in later years looks for compliance. That's number one. In addition to that, the Center for Economic Analysis has kicked off the first post-implementation review of standards that we have issued. They've announced that they're doing a post-implementation review of AS7, the Engagement Quality Review, to see how effective it is it achieving the results and objectives that standard was intended when the board approved it. I would expect that the CEA will look at other aspects of this and saying, is this rule providing the benefits to investors and other users regarding disclosure and engagement partners and other firms? And but those plans I think aren't firm yet. But Andres, maybe you can talk about CEA post-implementation and what you might think about in this regard.
Yes. Good morning. As you mentioned, Marty, the Center for Economic Analysis has a post-implementation review process, and one day it might perhaps undertake reviewing in a retrospective manner this particular standard. In particular, we could look at whether in fact in the U.S. context the identity of the engagement partner actually helps predict audit quality on a forward-looking basis. This type of observation has been made in other settings overseas, but the institutional characteristics of our marketplace, legal and otherwise, is different. So it would be very interesting to what extent it carries over to the U.S. Context. It has been found overseas that different reporting styles, for instance, the propensity of individual people to issue going concern, has an impact on the cost of capital of companies that they audit. It would be very, very interesting, although this would have to be done after a few years, to know whether that result in particular carries in the U.S. The bulk of our analysis assumes that, although not in a linear fashion, some of these effects might carry to the U.S., but it will be very interesting to know whether that has happened. It will also be interesting to know whether some other unintended consequences indeed happened while this particular standard was implemented. Thank you.
Steve?
Lisa, you commented on this, but we received a comment letter dealing with the search function and the accessibility of the information, and I don't know whether you or Steve want to comment on this, but what are the plans for making this readily accessible? And I assume it's going to be readily accessible on the website, and what actions have you taken to facilitate the accessibility?
Why don't we have Jessica answer a question?
I'm sorry.
But you can turn it to Lisa if you want.
Well, I was looking at Steve in the background, but
So we met with several of the commenters who talked about the search function and what they would like to see in the search function previously, before we issued this rule. And then we are working with IT to have them develop functionality for the website that people will be able to get the engagement partner, the firm, the name of the company, and other information, and they can click through. So he has shown us some different search functionality, and we have now, until the rule goes effective, to continue to develop the search functionality. And we will continue to reach out to investors and others that may want to have input into that.
Thank you. And then at this time, the board is not extending the Form AP filing requirements to brokers and dealers. Could you explain why not?
There are no brokers and dealers that are publicly owned. Brokers and dealers, some of them are owned by issuers, and others are smaller broker-dealers owned by basically the management group. And so the purpose of this is to provide information to investors and shareholders who don't otherwise know the names of the engagement partner and participants. Since in the case of most broker-dealers, the same management are the owner investors, that information is readily available to them as to who the name of the engagement partner is. And so the issue of the information asymmetry of what's available to management not being available to investors doesn't really exist in the broker-dealer world, where you really have a smaller community where the owners know those engagement partners. That's the primary rationale I have. Were there others? Andre?
You said it well. Thank you.
Andre said I said it well, so we'll stop there.
And the final question I have is, and you touched upon it, would you describe the conditions for voluntary disclosure in the auditor's report?
So first of all, the rule requires, first of all, that Form AP be filed for every audit of issuers when it's filed with the SEC. The rule also permits, however, that there be voluntary disclosure of that in the audit report. If voluntary disclosure is made in the audit report, voluntary disclosure could be of the engagement partner, or it could be of the other firms, or both. If it's made of the other firms, all other firms would have to be disclosed, and it couldn't be done selectively. So voluntary disclosure would be permitted. Now that, as for voluntary disclosure, with respect to the other firms, we are making amendment to an auditing standard AU 543, which currently says that you're not able, if you assume responsibility for the work of another auditor, the auditor can't state in the report that part of the audit was performed by another audit firm. That amendment that will be deleted from the auditing standards effective June 30, 2017. So when AP becomes effective for other firms could also be put into the audit report as well. With respect to the engagement partner, there are no prohibitions today with respect to naming an engagement partner in an audit report voluntarily today.
Are there any other questions or comments from board members?
Yeah. Jeanette,
No, I was going to ask a little bit more about the implementation and the guidance, but I think you all have laid that out, and so I appreciate the fact that you're thinking ahead on that. And I would encourage you to really make yourselves accessible for questions after we put that guidance out.
And we certainly want to receive questions, and then we'll think about those questions and answer them primarily in the guidance after the SEC hopefully approves the rulemaking.
So I've just got a couple more operational questions, and one of the areas where I was a little personally challenged on the rationale for it was the need to file an amended Form AP if there's another date on the audit report, and I was kind of struggling myself as to the rationale behind that. And I know some commenters that were maybe confused by what the requirement was. Could you just expand a little bit on that, and when an amended Form AP is required, and when it's not, more importantly?
We'll push this one back to Lisa.
In general, a new Form AP, an amended Form AP, is only required when there was an error or omission in the original submission of the original Form AP. So somebody spelt my name wrong. It's very easy to do. So they needed to file an amended report to correct my name. That's when you would amend it, only for an error or omission. In the case of a second report date, so I've dual dated the report, that's now considered issuing a new audit report with a second date, and it would actually be filing a new Form AP that would include the original report date, as well as the date to the dual dated content. If there was a second engagement partner because of rotation of an engagement partner, both the original engagement partner and the new engagement partner would be shown on that form, but it would be a new Form AP rather than amending of the original issued Form AP. And then all parameters for filing Form AP as a new form would be considered by the firm when they are doing that.
So just add to Lisa's if I can. One of the issues the commenters brought up said that we issue a report in connection with the 34 Act filing and file it in Form 10K with the SEC. In connection with a securities offering a few months later, we sign a consent with a new date, updating our audit report. Is a new Form AP required at that point in time? And the answer is no. The report is the same. The opinion is on the same set of financial statements. The date hasn't changed on the audit report. There's no need to file a new Form AP when you're filing a consent and there's nothing else that's changed.
So by extension, many times in actual securities offerings, there's amendments to those, say an S2 registration statement, that every time that new amendment to the registration statement filed another consent, unless the date changed, there wouldn't be a new Form AP.
Right. If that audit report stayed the same with the same date on that same set of financial statements, it would not change. If the registration statement, if there was a change in the financial statements which required a change in the audit report with a new date for some reason, change in accounting or something else, then that would require a new Form AP. So only in those circumstances.
And a subtlety within this, which I maybe the first 3 or 4 times I read it, I didn't appreciate, was would the accumulation of the hours for the other firms and relook to make sure that the percentages or the number disclosed for the other participants, if that changed as a result of the additional work done to support a reissued audit opinion and a new date, would that have to be updated as well?
Well, these are the types of things that we will address, first of all, in implementation in that staff guidance. But in general, you have to correct whatever an error was in the Form AP. So if there's a new Form AP filed because of an error, you correct it. If there's a new Form AP filed because some additional work was done, you'd have to consider what the additional hours were for that work. On the other hand, if you're suggesting that a new Form AP had to be filed because, as Lisa said, her name was spelled incorrectly and the new form was filed, if the firm had made a good faith estimate on the hours at the time of filing, they wouldn't have to make any change. If they became aware that there was also some error that the one firm actually did perform more than 5% and we didn't disclose that previously, and they made a bad estimate, then they should have to change that. But that would only be in cases where they were aware of the fact that they didn't make a good estimate. In general, the information would not change. You would only correct the error that was made on the form when you filed it.
So just one last question. That's I know from my personal experience, sometimes if you're auditing more than 1 year, it's kind of difficult to separate the audit hours between the years. And I think there were some questions about, well, how is that going to work if it's an audit covering multiple years? Would there be multiple Form APs, or would it just be one Form AP? How the hours would be treated?
Jessica, you want to take that?
If you did one audit for multiple years, then it would be one Form AP for that entire time. And you would there's a box I think you would check that says this is a multiple years over for this one Form AP. However, if you are doing an audit and there are multiple years, but you're only doing 1 year's audit, then it's only for that year. So there are ways that the Form AP will be able to distinguish that.
Okay. Sounds like you put a lot of work and thought into this, so thanks.
And it's a good reason why your encouragement for staff guidance is a good idea. So we'll continue to work on that and have that ready to be issued shortly after the SEC's approval of this to further enhance the understanding of this.
And refresh my memory about what the earliest possible date the SEC might approve it, or maybe what the reasonable expectation is.
I think the reasonable expectation is in about mid-April. Is that correct? About mid-April would be the SEC's approximate timing. The board approves this. We have to make a filing with the SEC. The SEC could take up to 105 days, which brings us to about mid-April. So the staff guidance would hopefully be issued very shortly after that, on or about the day after approval by the SEC. And again, the first thing that goes into effect is that's about April or May of 2016. The initial thing in effect is the name of the engagement partner after January 31, 2017. So that's a lot of time right there. And hopefully there aren't a lot of complications in just naming the engagement partner on a particular audit. The greater complications would probably go into place, later on in other auditors, and that doesn't go into effect till June. Reports issued after June 30, 2017. And so there should be enough time for firms to absorb the rulemaking, the staff guidance, and appropriately apply it in 2017.
Okay. I've been a very strong supporter of the use of a unique identifier here, so that there are not confusions by people who have common names. As I understand, the way we've done this so far is that identifier will have two components to it. One, a unique individual identifier, and a firm digital identifier. given the fact that particularly in smaller firms, auditors oftentimes change firms, so their unique identifier could change over time. Will there be a way that will allow someone to search this database to make sure that they can link this together so that over time they can trace the history of a particular individual even as he moves around among firms?
Answer to your question is yes, but I'll go into your identifier a little bit and then talk about it. So the components of the 10-digit identifier, first of all, is the firm's 5-digit identifier. All firms registered with the PCAOB have an identifier number. Some of them might be a number like 134, but it's really 00134. Somebody might have a number like 1000, which really is 01000. So they all have a 5-digit identifier. And so immediately the identifier will indicate, well, what firm is this partner with, because the first 5 digits relate to the firm's identification. The second 5 digits is a series of numbers that the firm will give uniquely to each partner, and so there's a unique identifier for the partner and as well as connecting him or her with a firm.
Does that partner keep that unique identifier of the individual in it for the rest of his career, even if he changes firms? Is that correct? So when it's first assigned, you have that forever.
When it's first assigned to that partner, the partner has that unique identifier for as long as he or she is with that firm. As you said, a partner may change firms. If a partner changes firms, that number is retired and can't be used again. He or she gets a similar new 10-digit number from the new firm that he or she goes to, but Form AP requires that if you had that the firm have to include on that Form AP any previous unique identifiers that partner had, so that partner's history and engagements that he or she performed would be traceable from whatever firms and whatever identifiers he or she had.
Back effectively to the first time the person got that.
Effectively to the very first.
We'll be able to see the entire history of that individual person.
Irrespective of how many firms that person changed.
20 years from now, for example, if I'm searching when I'm 112 years old.
That's more than 20 years.
Could happen.
No, whatever. If I'm searching when I'm 112 years old, I will be able to see the entire history of someone going back to the first time they were
That's correct. That's correct.
Any further questions by board members? Questions? Comments? Then it's my privilege and pleasure to call for a vote. But all board members in favor of approving this recommendation, please say yes.
Yes.
Yes. Any board members who oppose, please say no. Hearing none, the votes are unanimous. This concludes our agenda today. Thank you. We're adjourned.